Welcome to the Pro Ticker Deep Dive.
It's really great to be back. And frankly, I don't think we could have picked a better day to just sit down and look at the markets.
I completely agree, because today we are looking at a financial mystery that honestly feels like it was written for a suspense novel.
Yeah.
But it is actually just the cold, hard reality of the markets right now in February 2026.
Right, the reality of the crypto market.
Exactly. We are looking at a company that just reported, literally this morning, a 22% increase in revenue.
A huge jump.
They are mining Bitcoin at a massive discount relative to the market price, and yet they just reported a net loss of nearly $60 million in a single quarter.
It's the ultimate paradox of profit and loss.
Yeah.
You have the top line booming, the factories humming along, and the bottom line just looks like a crime scene.
A total mess.
And to make it even more interesting, the company is American Bitcoin Corp, ticker ABTC.
Right.
Which is deeply intertwined with the Trump family, specifically Eric and Donald Trump Jr.
Exactly. So we are looking at the Q4 2025 earnings, which dropped today, February 26, 2026. And the context here is absolutely vital. We are in what some people are calling the return of crypto winter.
Yeah, the winter's definitely back.
The Bitcoin has corrected from those dizzying highs we saw of $126,000 down to the $60,000 range.
That is the backdrop. The wind is howling, prices are down, and everyone is checking their portfolios with one eye closed.
Hoping for the best.
Exactly. But this deep dive isn't just about one mining stock. It is really a story about three massive converging trends.
Okay, let's lay those out.
First, you have the mechanics of industrial mining colliding with new accounting rules.
The new FASB rules.
Right, rules that essentially turn balance sheets into roller coasters. Second, you have what we are calling the Great Pivot.
Which is fascinating.
It really is. This is where energy infrastructure is actually becoming more valuable than the crypto it produces.
And the third trend?
The third is the collision of politics and decentralized finance.
Right.
Because in the second half of this discussion, we have to look at World Liberty Financial, or WLFI.
The separate project.
Yes, a separate but related DeFi project involving the Trump family. And that has its own drama involving governance tokens, stablecoins, and some very interesting regulatory questions.
Involving names like Justin Sun.
Exactly.
So we're covering accounting quirks, energy markets, and political intrigue today.
We really need to unpack the financial mechanics, the ethical questions, and frankly, the survival strategies of these companies.
So let's start with the headline numbers for American Bitcoin Corp. Because if you just look at the top line, it looks great.
It does.
They released their Q4 2025 results this morning. Revenue came in at $78.3 million. That is up 22% quarter over quarter.
And if you zoom out, if you look at the full year for 2025, revenue was $185.2 million.
Wow.
Compare that to $71.5 million in 2024.
So they more than doubled it.
That is massive growth.
Yeah.
I mean, we are talking about a company that is rapidly scaling up operations.
They're plugging in more machines.
They are plugging in machines. They are mining more coin. On the surface, if you just looked at the revenue chart, this looks like a booming business.
But then you scroll down.
Right.
You get past the revenue, you get past the gross profit, and you hit the bottom of the spreadsheet. And you see the scary number.
The net loss.
A net loss of $59.45 million for the quarter.
Yeah.
And for the full year, a net loss of $153.2 million.
It's a tough pill to swallow.
So lay it out for us. How do you almost double your revenue and lose that much money? Is the business completely broken?
This is where we really have to put on our accountant hats for a second. And I promise you, stay with me because this is actually fascinating.
I'm with you.
This is entirely about the rules of the game changing, specifically the Financial Accounting Standards Board, or FASB.
FASB.
Yeah.
The people who make the rules on how corporations count their beans.
Exactly. Now, to understand why this loss looks so incredibly bad today, you really have to understand how it used to work.
Okay, take us back.
Before the recent changes, Bitcoin was treated as an intangible asset with an indefinite life.
Meaning what, exactly?
Think of it like a trademark or a patent.
Okay, so like the Nike swoosh.
Right. Perfect example. And under the old rules, which we call the impairment model, you only recorded a change in value if the price went down.
Wait, really?
Yes. If you bought Bitcoin at $50,000 and it dropped to $40,000, you had to report a loss. You had to impair the asset.
Okay, that makes sense.
But, and here's the kicker, if the price went back up to $60,000, You couldn't report that profit.
You could only report the bad news.
Exactly. You could only report the drop unless you actually sold the Bitcoin.
So if you just held it, your books look terrible.
Terrible. Companies like MicroStrategy or Tesla would have these balance sheets that looked awful because they took all the hits on the way down but showed absolutely none of the gains on the way up.
It was basically a one-way street to a bad earnings report.
It was.
That
So the industry begged for a change, they lobbied hard, and they finally got it. FASB issued a new rule. It switched the model to fair value accounting.
Fair value? That sounds a lot more logical.
It is better, in theory. It means that every single reporting period, so every quarter, you have to look at the market price of Bitcoin right then and there.
And you just update the spreadsheet.
You adjust the value of your holdings on the balance sheet to match the current market price, up or down.
So you get total transparency. You mark it to the market.
Yes, but here is the double-edged sword.
The catch.
In Q4 2025, Bitcoin took a nosedive. The price dropped about 23% during that 3-month window.
From the highs down to the 60,000s.
Right. And American Bitcoin Core is holding a massive treasury of Bitcoin.
Over 5,000 coins by the end of the year, right?
Yes. So when the price dropped, the value of that massive treasury on paper dropped right along with it.
So that $59 million loss.
It is almost entirely Fanto. It includes a $227.1 million non-cash mark-to-market loss.
$227 million just vanished.
On paper, yes. Look at it this way. Imagine you own a house.
Oh.
You bought it for $500,000. In June, the market is hot, and Zillow sends you an email saying your house is now worth $800,000.
I feel great. I might even tell my friends I'm worth nearly $1 million.
You definitely would, but you didn't sell the house. You still live there.
Right.
Yeah.
I haven't realized those gains.
Then, fast forward to December, interest rates go up, the real estate market corrects, and Zillow sends you a new email. Your house is now worth $600,000.
Ouch.
Your net worth on paper just took a $200,000 hit.
Right.
If you are a publicly traded company under these new FASB rules, you would have to report a $200,000 loss to the SEC.
But I didn't write a check for $200,000.
No.
I still have the exact same house.
Mhm.
The roof is still there. The kitchen is still there.
Exactly. You didn't lose any cash.
Yeah.
You didn't sell the asset. And that is exactly what happened to ABTC.
They hold the Bitcoin.
They hold the Bitcoin. The Zestimate on their Bitcoin stack went down because the broader market corrected.
So they have to report a massive loss.
But cash-wise, they didn't actually bleed that money from operations.
So ABTC is the house owner in this analogy.
Mm-hmm.
Their property value went down, so they have to report a loss. But this creates a huge perception problem, doesn't it?
Oh, absolutely.
Because headline readers just see the word LOSS in giant red letters.
It totally obscures the actual operational efficiency of the business. If you are a casual investor or maybe an algorithmic trading bot reading headlines, you see net loss 60 million and you just sell.
But if you strip away that paper loss, that mark-to-market adjustment, and look at the actual mining economics, the picture is completely different.
That is the bull case the analysts are clinging to. Let's look at the gross margin.
Okay, let's look at it.
53% in Q4.
Wow.
That is incredibly healthy. I mean, in a world of hardware and heavy industry, a 53% gross margin is fantastic.
It implies that despite the market downturn, their machines are running very efficiently.
They are, but the key stat that really jumped out at me from the earnings report is their cost of production.
I saw that number, and I honestly had to double-check it. They mined Bitcoin at a cost of roughly $46,900 per coin.
Think about that spread for a second. Even with Bitcoin crashing to 60,000 or 62,000 in this crypto winter, they are still making a profit of roughly $13,000 to $15,000 on every single coin they mint.
That is the structural discount they keep talking about in their press releases.
It is exactly that. If you or I want a Bitcoin right now, we have to go to an exchange and pay $60,000.
We pay the full retail price.
Right, ABTC. They pay for the electricity, they pay for the cooling, they pay for the ASIC mining machines, and they get that same Bitcoin for 46 grand.
They are acquiring the asset at a 53% discount relative to the spot market.
So operationally, the factory is working perfectly.
The factory is printing money. I mean, in Q4 alone, they mined 783 Bitcoin.
And by February 2026, their total holdings grew to over 6,000 BTC.
That is a massive stockpile.
So operationally, the machine is doing exactly what it is supposed to do. The loss we see is just the market repricing the inventory they decided not to sell.
Which brings us to their core strategy. Because if they were just a normal old-school miner, they might sell that Bitcoin every month to pay the electric bills and buy new machines.
But they aren't doing that at all.
Right, they call themselves a Bitcoin accumulation platform.
That is a branding pivot, but it describes their business model very accurately. It is a dual-pronged strategy.
Okay, walk us through the prongs.
Prong one is what we just discussed, mining. Generate BTC at cost.
Make it cheaper than you can buy it.
Exactly. But prong two is where it gets very aggressive, treasury management.
Which essentially means raising cash to buy more Bitcoin.
Precisely. They are raising cash from the stock market to buy more Bitcoin on the open market.
They aren't just satisfied with what they can mine from their own machines.
No, they want to act like a black hole for Bitcoin. They want to absorb as much of it as possible.
And they were incredibly aggressive with that in Q4. I noticed they raised $150.5 million via at-the-market equity offerings.
ATM offerings, yes.
Now, we hear this term ATM offering a lot in the mining space. How is that different from a normal stock sale? Because if you are a retail investor, this stuff can get confusing.
So usually when companies raise money, they might do what's called a secondary offering.
Okay.
They go to a big investment bank, they say, we want to sell 10 million shares, and they sell a big block all at once to institutional buyers.
Right, a lump sum.
An at-the-market or ATM offering is completely different. It is like turning on a tap.
A tap?
Yes. They authorize a bank to sell shares directly into the stock market, bit by bit.
Just a little at a time.
Exactly, day by day at whatever the current market price is.
So they're just dribbling new shares out constantly into the open market.
It is a very flexible way to raise cash. When the stock price is high, they turn the tap on and sell shares to raise money.
And they took that $150 million they raised from selling that stock.
And plowed it right back into buying Bitcoin on the spot market.
But wait, if I am a shareholder of American Bitcoin Corp, doesn't that make me angry? They are printing more stock. That is inflation. That is dilution.
Yes.
My piece of the pie is getting smaller.
You are exactly right. In almost any other industry, dilution is a dirty word.
Right. If Apple printed 20% more shares just to buy gold bars, shareholders would revolt.
They would fire the CEO tomorrow. But ABTC argues that this dilution is accretive.
Accretive. That is the magic word in their earnings calls.
It is their entire defense. And to prove it, they use a specific metric, Satoshis per share, or SPS.
Okay, let's unpack this because this is really the core of their defense. A Satoshi is the smallest unit of a Bitcoin.
Right. 100 million Satoshis make one Bitcoin.
Like pennies to a dollar.
Exactly. And the SPS metric tracks how much Bitcoin backs every single share of stock.
Okay.
The logic they use is this. Yes, we printed more shares. We diluted you. But we used that money to buy so much Bitcoin that the amount of Bitcoin you own per share actually went up.
It sounds a bit like financial alchemy. Can we use an analogy here?
Yeah.
Because I feel like it is easy to get lost in the math.
Let's use the pizza analogy.
I love a pizza analogy.
Imagine the company is a pizza. You own one slice. Initially, the pizza is cut into 8 slices, so you have 1/8 of the cheese and pepperoni.
I am with you.
Now, the company decides to issue more shares. That is like cutting the pizza into 16 slices.
Suddenly, my slice is half as wide. That is dilution.
Yeah.
I have less pizza. I am upset.
Right, you would be. But ABTC is saying, hold on. Yes, we cut the pizza into 16 slices, but we used the money from selling those extra slices to buy 3 more pizzas and stack them on top of the first one.
Yeah.
So even though your slice is thinner effectively, the stack is much, much deeper.
So the total volume of cheese and pepperoni, or in this case, the underlying Bitcoin, that represents my thinner slice has actually increased.
Exactly. You own a smaller percentage of the overall company, but the company itself has grown so much in asset value that you are technically winning.
Did it actually work out that way in the numbers for Q4, or is this just theoretical marketing speak?
Mathematically, yes, it worked. In Q4, their Satoshis per share increased by 49%.
Wow.
It went from 371 Satoshis per share to 554.
So even though they diluted the stock heavily, the Bitcoin backing each individual share went up by nearly half.
It is a massive jump, and management Eric Trump and CEO Mike Hurrow are really hammering this exact point on the earnings call.
They view the company as a vehicle for compounding reserves.
Yes. If the SPS keeps going up, they argue the stock price should eventually follow, regardless of how many shares they have to issue to get there.
It is the exact same playbook MicroStrategy used to become a giant.
It is a carbon copy of that playbook.
But there has to be a catch. You cannot just print stock and buy Bitcoin forever without some level of risk.
Right.
This isn't a perpetual motion machine.
The risk is liquidity.
Okay, let's talk about liquidity.
They are betting everything, and I mean everything on the asset itself. I looked at their balance sheet liquidity ratios, and one number absolutely stopped me in my tracks.
What was it?
Their current ratio is 0.07.
0.07.
Yes.
That is microscopic.
It is incredibly low. For context, for anyone who isn't a CPA, the current ratio measures your ability to pay your short-term bills.
Right.
It compares your liquid assets, mostly cash, to your short-term liabilities, which are bills due in the next 12 months.
So what is a normal healthy number?
A healthy current ratio is usually over 1.0. It means you have $1 of cash on hand for every dollar of bills coming due.
And ABTC has 7 cents.
Basically, yes. 0.07 means their short-term obligations vastly exceed their liquid cash.
Because all of their money is locked up in Bitcoin.
Bitcoin and physical mining rigs. They are incredibly asset-rich, but they are cash poor.
This is the leverage trap.
It is exactly that. They are betting the company's absolute solvency on the long-term price appreciation of Bitcoin.
They don't want to sell the Bitcoin to pay the bills because that defeats the entire purpose of their accumulation strategy.
Right. So they have to keep raising cash through the stock market, or they have to delay payments.
But what happens if this crypto winter lasts 2 years?
That is the nightmare scenario.
Right. What if Bitcoin stays at 60,000 or drops to 40,000 and just stays there?
Then that 0.07 ratio becomes a noose.
Because they can't raise money via stock if the stock price crashes.
Exactly. Nobody wants to buy the new shares if the stock is plummeting. They don't have cash in the bank, so they might be forced to sell that precious Bitcoin stack just to keep the lights on.
And they would be selling it at the absolute bottom of the market.
Which is the worst possible time.
So they're essentially playing a high-stakes game of chicken with the market cycle. They are betting they can outlast the winter.
Precisely. And that leads us to the broader industry context, because not everyone in the mining space is playing this specific game.
Right. While ABTC is doubling down on Bitcoin, the rest of the industry is doing what they're calling the Great Pivot.
Yes.
This is the shift from exahash to megawatts. I have seen this headline absolutely everywhere
It
lately.
is the defining narrative of 2026.
Okay, let's break that down,
For the last decade, Bitcoin miners were valued on exahash.
which is basically their computing speed.
Right. How much computing power do you have? How fast can your machines guess the cryptographic lottery numbers to win the next Bitcoin?
But now Wall Street is completely changing the metric,
They are. Wall Street is now valuing these companies on megawatts.
meaning power.
Yes.
Yeah.
How much power access do you have? Not how many computers you have, but how much electricity you have the legal right to consume from the grid.
Because of AI.
Because of artificial intelligence, it is a power-hungry beast.
Training these massive language models requires gigawatts of reliable, steady power.
And the U.S. power grid is incredibly congested.
You can't just plug a new data center into the wall.
No. It takes 4 to 6 years to build new high-voltage transmission lines and get the grid connections approved by the regulators.
But Bitcoin miners, they already have the connections.
Exactly. They spent the last 5 years scouring the country for power capacity. They went to rural Texas. They went to upstate New York.
They did the hard work already.
They are sitting on fully energized sites with giant transformers and substations ready to go.
So the miners are realizing they can just become AI landlords.
That is the new business model.
Look at their competitors. Look at Applied Digital.
They are building for high-performance computing, or HPC, from the ground up. They are putting in liquid cooling for AI servers.
And Core Scientific.
Core Scientific is hosting CoreWeave's GPUs. They are turning what used to be called stranded power into steady, high-margin rental income.
Rental income from tech giants like Microsoft or OpenAI. And then there's Hut 8. Now this gets a little confusing because Hut 8 is essentially the parent company, or at least the former parent company of ABTC, right?
It is a fascinating corporate divorce.
Walk us through the split.
Hut 8 basically spun off his mining rigs into ABTC.
They gave them the computers.
Yes, but Hut 8 kept the physical infrastructure and the power plants.
Oh, that is a crucial detail.
It is the whole story. In fact, Hut 8 just sold natural gas power plants to pivot their capital into building data centers.
And they secured a massive lease, right?
A 15-year, $7 billion lease backed by Google.
$7 billion backed by Google. That sounds a lot more stable than hoping Bitcoin goes back to $120,000.
That is exactly the logic. Hut 8 chases stable, compounding AI revenue. They want to be an infrastructure utility.
And they spun off ABTC to chase the volatile Bitcoin upside.
Right. ABTC is the asset-light model.
Meaning they don't own the building.
They don't own the buildings, they don't own the transformers, they just use Hut 8's infrastructure via a master services agreement.
So ABTC avoids the massive construction costs. They don't have to pour concrete or buy steel.
Which keeps them nimble. But it also means they are essentially renting space from their former parent.
And that introduces counterparty risk.
A lot of it. They rely completely on Hut 8 to keep the power on.
And as Hut 8 pivots harder into AI, you really have to wonder, does ABTC get pushed to the back of the line for that power?
That is the big question. If Google wants the megawatts for AI and ABTC wants the exact same megawatts for Bitcoin, who wins?
I think we know who wins that fight.
Usually the one writing the $7 million check.
Yeah.
It is a huge strategic vulnerability for ABTC.
Let's talk about the stock price, because if you are an ABTC shareholder right now, the last few months have been absolutely brutal.
Brutal is putting it mildly.
The stock is trading around $1.06 as of today, February 26th.
Which is down about 90% from its peak of $9.40.
That is a catastrophic drop for anyone who bought the top. And a lot of it happened very suddenly back in December.
It did.
I remember reading about a flash crash where it dropped 50% in a matter of minutes. It even triggered trading halts on the exchange. What exactly caused that?
That was a specific trigger event known as the lockup expiry.
Okay, explain that concept for listeners who might not trade IPOs or SPACs.
When a company goes public, or in this case when they merge and list on an exchange, the early insiders have restrictions.
The private equity guys, the founders.
Right, the people who got in way before the general public did, they're usually forbidden from selling their shares for a certain period.
Often 6 months or 180 days.
Yes. That is the lockup period. It prevents them from just dumping all their shares immediately and crashing the price on the retail investors.
So the lockup expires and the floodgates essentially open.
Exactly. In December, that deadline hit for ABTC. The pre-merger private placement investors were finally legally allowed to sell.
And they did.
They ran for the exits. They cashed out incredibly aggressively.
It almost sounds like they didn't believe in the long-term vision of the company.
Or they just wanted to secure their massive early gains. You know, Eric Trump actually tweeted about it at the time.
What did he say?
He acknowledged that early investors were cashing in profits, but he affirmed very strongly that he wasn't selling his own shares.
He tried to calm the waters.
He did. He wanted to show he was still aligned with the long-term vision.
But the market really didn't care.
The market panicked anyway, but there is another layer here that we have to discuss. The Trump premium.
Right.
For a while, ABTC was trading at a massive valuation disconnect. The stock price implied a total company value that was far, far higher than the actual Bitcoin they held in their treasury.
Because of the name attached to it.
Because of the name, the political momentum, and because Bitcoin itself was at $126,000.
It was a meme stock dynamic.
Completely. People were just buying the Trump Bitcoin stock.
So when the lockup expired, that premium just evaporated. The hype bubble burst.
It did. And now, strangely enough, we have the exact opposite situation.
The stock is oversold.
The stock is beaten down so badly that it is trading closer to, or maybe even below, the net asset value of its Bitcoin holdings.
Which explains why some analysts, like the folks at Roth MKM, have a 100% buy rating on it.
It is the ultimate deep value investor argument.
They're saying the baby got thrown out with the bathwater.
Exactly. The argument is, look, the stock is beaten down so much that you are basically buying Bitcoin at a discount by buying the company's stock.
Let's do the math on that.
If the company holds $500 million in Bitcoin, but the total stock market cap of the company is only $400 million.
You are buying $1 of Bitcoin for 80 cents.
Exactly.
But that assumes the company doesn't run into those liquidity problems we mentioned earlier.
Right.
If they go bankrupt because they only have 7 cents for every dollar of debt, that 80-cent discount doesn't matter at all.
It doesn't. It's a high-risk value play. The underlying asset has to survive the corporate wrapper.
So that is the state of the mining operation. High revenue, paper losses due to FASB rules, extreme liquidity risks, and a totally beaten down stock price.
That's a lot to process.
But the Trump crypto story doesn't end with industrial mining. We have to talk about the other side of the coin, literally.
World Liberty Financial.
WLFI. This is where we move away from industrial mining heavy machinery, electricity grids, physical infrastructure, and we step into decentralized finance, DeFi.
And the ambition here is arguably even bigger than the mining company.
This is the project where Donald Trump is officially listed as the chief crypto advocate.
Yes.
And his sons are the Web3 ambassadors.
Those are definitely quite the titles.
They are. And let's be very clear about the financial structure right up front, because it was a huge point of contention in all the sources we reviewed.
The revenue split.
Yes. A Trump-affiliated entity, DT Marks DeFi LLC, is entitled to 75% of the net protocol revenue.
75%. I really want to pause on that number for a second. In the broader crypto world, developer teams usually take a cut of the fees.
Sure, to fund development.
Maybe they take 10%, maybe 20% for the community treasury.
But 75%.
75% of net revenue going to a single private entity is exceptionally high. It firmly establishes this as a family business venture, not just a decentralized community project.
So what is WLFI actually doing to generate that revenue?
Yep,
They have
yep.
a token, right?
They have the WLFI token. Originally, it was marketed strictly as a governance token.
But initially, it was non-transferable,
Yes, meaning you couldn't sell it. It was locked in your digital wallet.
which is very unusual for crypto. Usually, the entire point for early investors is trading the token.
It was very unusual, but that changed. Now they are rolling out a complex governance structure to make the token useful and give it intrinsic value.
I saw the proposal about staking.
Yes. To vote on the future of the platform, to have any say in how this protocol runs, they are proposing that you have to lock your tokens up for 180 days.
6 months.
Right?
In crypto time, 6 months is an absolute eternity. A whole market cycle can happen in 6 months.
It is a lifetime. But the incentive they're offering is a potential yield. Not guaranteed, but potential.
A 2% annualized yield.
Plus the voting rights. They are trying to create a stable, long-term base of holders rather than day traders who dump the token the moment it pumps.
And they have this tiered system for the holders. Nodes and supernodes?
Yes.
It sounds very video game-ish to me.
It sounds a bit sci-fi, but financially it is basically a country club membership structure.
How does it work?
If you stake more than 10 million tokens, you are designated a node. If you stake more than 50 million, you are a supernode.
And what does being a supernode actually get you? Do you get a special badge?
You get special access.
Yeah.
Specifically, the protocol's white paper mentions access to market makers and exclusive partners.
So it is networking.
It implies a level of networking and deal flow that the average retail investor just does not get.
And this is where it connects to their other really big ambition, the USD1 stablecoin.
USD1, a dollar-pegged digital coin.
Their stated goal here is to preserve dollar hegemony.
The argument they are making is that stablecoins are the undeniable future of global money, and if the U.S. doesn't lead in creating them, China or someone else will.
So they want to launch a stablecoin backed by physical cash and U.S. treasuries.
Held by BitGo, a major crypto custodian.
And there was a massive deal mentioned in the sources, $2 billion involving Abu Dhabi.
Yes, MGX, which is an Abu Dhabi investment fund, used the USD1 stablecoin in a major deal with Binance.
That is instant market validation.
It really is. A lot of stablecoins struggle for years to get any real liquidity. This specific deal puts billions of dollars of volume through their system almost overnight.
It proves the plumbing actually works.
Yes, and now they want to take it a huge step further.
They want to become a bank.
They are actively applying for a national trust bank charter with the OCC.
The Office of the Controller of the Currency.
That's right.
That is a big deal. The OCC regulates the biggest banks in the country.
It is a huge deal. If they get that charter, they can bring all the stablecoin issuance and custody in-house.
It wouldn't need BitGo anymore.
Exactly. They would essentially be a federally chartered crypto bank. They could issue digital dollars directly to the market.
A federally chartered bank controlled by the family of the president, who also receives 75% of the protocol revenues.
You can see exactly why this is raising some eyebrows in Washington.
It blurs the lines between public service and private enterprise in a way we haven't really seen before.
Which brings us to the pay-to-play allegations.
Right. The sources mention a very specific timeline involving Justin's son.
Justin Sun, the founder of the Tron blockchain.
He is a very well-known name in the space.
He is one of the most controversial, colorful figures in all of crypto. He is known for massive marketing stunts, but also for having serious run-ins with regulators all over the world.
So lay out the timeline for us, because the sequence of events here is what has people talking.
Okay, here is the exact sequence reported in the sources. First, Justin's son invests over $30 million into WLFI.
Making him the largest single investor in the project.
Correct. Second, he buys massive amounts of the Trump Primp meme coin.
Which isn't directly affiliated with the family business, but symbolically it is important.
Right, he is showing public financial support. Third, there is an intimate dinner and gala.
Okay.
Justin's son attends, meets Donald Trump. There are photos of them shaking hands. Son reportedly received a gold watch as a gift.
And then comes the regulatory twist.
Shortly after this sequence of investments and meetings, the SEC officially paused a major fraud case against Justin's son.
Pause it.
Now, we have to be incredibly careful here.
Absolutely.
Correlation is not causation. We cannot say there was a quid pro quo.
The administration would argue, and they have argued publicly, that they are simply stopping regulation by enforcement.
Exactly. They believe the SEC was vastly overstepping its bounds under the previous administration, and they're pausing many cases against crypto entrepreneurs right now, not just Son's case.
So the administration's defense is, we aren't doing this specifically for Justin's son. We're doing this for the health of the entire industry.
That is the policy defense. But the House Judiciary Committee and Democrats released a report alleging this looks exactly like a pay-to-play scheme.
The argument being, you invest $30 million in the family business, you get FaceTime at a gala, and suddenly your regulatory problems go away.
It is the appearance of impropriety that is fueling the fire. Even if it is purely a broad policy shift, the optics are incredibly complicated.
Yeah, and it got even messier with the freeze drama.
Oh, this was strange.
Justin's son's tokens got frozen.
Yes. Despite being the biggest investor, the guy who put in $30 million bucks, his WLFI tokens were suddenly frozen by the protocol.
He couldn't move them or sell them? Why?
It is unclear exactly why, but Son's reaction was bizarre.
What did he do?
Instead of suing them or complaining publicly on social media, he tweeted that he would buy $10 million more just to prove his loyalty and get them unfrozen.
That is not normal investor behavior. If my bank froze my checking account, my first instinct wouldn't be to send them more money to apologize.
It highlights the centralization of the project. In a truly decentralized protocol, a real DeFi project, no single entity can just freeze your tokens because they feel like it.
Right. In DeFi, code is law.
But WLFI, despite the decentralized finance name, clearly has centralized control levers. They can flip a switch and freeze a massive whale.
It scares a lot of DeFi purists.
And it is not just Justin's son dealing with the centralization issue. There is also drama with Aave.
Aave, the lending protocol.
Yes, WLFI is built directly on top of Aave v3 technology.
They didn't write the smart contracts from scratch.
No, they used Aave's open source code. And the original proposal, the handshake deal, effectively, was that the Aave DAO would get 20% of the fees generated by WLFI.
The DAO being the decentralized community that runs Aave.
Right. They were supposed to get 20% of fees and 7% of the total WLFI token supply.
So it's pitched as a partnership. Aave provides the underlying tech, WLFI provides the brand, and brings in new users.
Exactly. But now that WLFI is established, there are rumors and reports circulating that WLFI might be trying to renege on that deal, or at least reduce the revenue share.
Can they legally do that in DeFi?
Well, the Aave founder insists the original deal is valid. But if WLFI decides to fork the code, meaning they copy it and run it on their own servers without the link back to Aave enforcement, becomes very tricky.
It raises a fundamental question about the project.
Is this really DeFi, or is it just a centralized fintech company using blockchain rails? If you can renege on a DAO community vote, you aren't really doing DeFi.
It feels like we are watching a stress test of the entire industry right now.
We absolutely are. We have the stress test of the accounting rules with ABTC.
Can the balance sheet survive the FASB volatility?
Right. We have the stress test of the pivot to AI. Can miners successfully become data centers without losing their edge?
And we have the stress test of political ethics in the WLFI project.
Can you mix high-level politics with decentralized finance without breaking the system?
So let's synthesize all this.
Yeah.
We have talked about a lot of moving parts today.
A lot to digest.
ABTC is an aggressive, high-leverage bet on Bitcoin. They're using equity dilution to relentlessly stack coins, even while operating at a huge paper loss.
And WLFI is a governance experiment testing the boundaries of political ethics, banking regulations, and DeFi.
For the listener tuning in, what is the core takeaway here? Why should you care if you aren't holding ABTC stock in your portfolio?
I think the biggest takeaway is the profound risk of hero worship investing.
Explain that.
The Trump connection created a massive, almost irrational premium on the stock in 2025. People bought it strictly because of the name attached.
They thought the name provided a safety net against the market.
But when the basic market mechanics kicked in, specifically that lockup expiry, the premium evaporated instantly.
Gravity applies to everyone.
The market simply does not care whose name is on the door if the liquidity isn't there.
It also feels like a strange sign of maturity for the sector. We aren't just talking about wild mining rigs running in a garage anymore.
No, we are talking about complex FASB accounting rules, national OCC bank charters, and massive governance proposals.
The Wild West is basically being paved over.
But the new roads are being built by very powerful, politically connected interests. The days of the anonymous cypherpunk miner are fading. The days of the Digital Asset Treasury Corporation are here.
Which leads me to a final thought I have been mulling over while researching this.
Let's hear it.
If American Bitcoin Core continues to accumulate Bitcoin at this relentless pace, getting to top 20 global holder status, and if WLFI succeeds in becoming a federally chartered stablecoin bank,
Yes.
are we looking at a future where a single political family essentially privatizes a significant portion of the U.S. monetary infrastructure?
That is the multi-billion-dollar question. If they control the digital dollar via a stablecoin and a massive reserve of the digital gold via mining,
That is a level of financial power we haven't really seen in modern American politics.
it brings up profound questions about blind trusts, about conflicts of interest, and about the very separation of state and money.
And on the flip side,
Mm.
if Bitcoin doesn't recover, if we stay stuck at $60,000 or drop even lower,
Then you have massive, dangerous leverage built up in these systems. And leverage in a downturn usually ends in only one way.
it unwinds.
It unwinds, and when it unwinds, it is usually incredibly messy.
A sobering thought to end on. We will definitely be watching the charts, the FASB filings, and the regulatory news very closely. Thanks for joining us for this deep dive.
My pleasure. It was a great conversation.
And thank you for listening. We will catch you on the next one.